with recording. Two things that you guys asked me to ask Wiley, which I've asked Wiley, and I'm recording this so that if anybody doesn't remember, you'll go back to today's lecture. You asked me if you can navigate between the questions on the test without actually doing the question and submitting it first. So for instance, if you prefer to answer question 10 first, you have to answer question 1 through 9, or will you be able to get past, let me put it this way, will you be able to get past question 1 through 9 to get to question 10? The answer is yes. You can click through prior questions to get to the ones that you actually want to answer. I would say if you do that, this is not like a paper test where it becomes maybe obvious that you didn't answer something in your blue book or whatever. I think just make sure that if you are doing the questions in the wrong quote unquote order, that you just watch your score or whatever on top to make sure that you've actually attempted everything, or write down on a paper or check off to make sure that you've answered all the questions and leave enough time for everything. And because the test usually starts with multiple choice first and then exercises, but you can skip over. Also, she also highlighted this, and I remember saying this, and I'll say it again. If you do a question, but you don't want to submit it yet because you don't want to lose one of your attempts, please save for later. That doesn't impact the amount of submissions that you've used. But if you don't save, like if I do a whole retained earnings calculation or a whole dividends journal entries thing, and I say, oh, I don't want to submit yet because I'm worried that something might be wrong, and then I'm going to go to attempt number 2 and I'm going to run out of attempts. If I don't save it and I click on to the next question, I will lose my work, okay? Because the system cannot retain information that hasn't at least been saved. You don't have to submit, but you do need to save, all right? So again, we've had tragedies like this in the past where I've had students who did work, didn't, I guess, listen to this warning, right? PSA people didn't listen to this warning and just did work, moved on question to question, thought they were done with the test and X'd out of the test. And then when the grade came up at the end, they had 0, and then contacted me in a panic to say, but they did do the work. For the most part, I am, going to ask some questions, but I believe that people should get at least one chance. Like I do believe in grace, so you should at least get one chance to fix whatever was went wrong. And when the person said they didn't save, I was like, oh, that's what went wrong, so that they go back and redo the whole thing from scratch. Don't let that be you. Save for later if you don't want to submit. Yes, you can click between questions. The second thing that you asked me to ask Wiley was, are you obligated to accept assistance that will cause your grade to drop? She said, absolutely not. You can opt when that option comes up. The system will, bring the prompt up. You can opt out of getting any help, so that even if you do 3 attempts, 4 attempts or whatever, you can still get 100% on the exercise. So that's important, because I think some people were concerned that as soon as they get to the 3rd attempt, they will lose out. But the policies, and I've said this before, I'll say it again, the policies that are linked to the test will come up before you even start the test, but people may read it and then forget exactly what it said. So just remember that you don't have to accept the help that is being offered if you want to still try and get 100%. But obviously at some point, if you're really struggling with a question and you're starting to run out of time and you don't know what's going on, you may want to click on assistance to at least get 85% or whatever on that question, instead of getting 60% on the question. So so that's up to you how you navigate it, but it's not obligatory for you to take any help on the test. Please remember that though, for the quiz, for the multiple choice, because it's multiple choice, you will, by the 3rd attempt, you will be cut down to 60%. There's no option to opt out of losing those points, because it's for A, B, C, D, right? So I have to do something to prevent people just from clicking from one thing to the next and just checking if the answer is right, and it becomes a guessing game and everybody gets 100%. That's not the point. a test or a quiz is about you showing me what you know, not about, a guessing game, magic trick situation. So if by the time you get to the third attempt, you will be penalized, and you will then just be able to pass the question at 60%, but you won't be able to get a higher grade than that. So with the quiz, please be careful. Once you click an answer and click submit, that's attempt number 1. And if it's wrong and you go again, attempt number 2, if it's wrong by attempt number 3, you're down to 60%. If you get it right on attempt number 2, you're still on, if you get it right on attempt number 1, you're on 100%, attempt number 2, you're on 100%. But once you, click on submit for attempt number 3, if it's at that point, if it's wrong and you go to basically attempt number 4, so now you know what the answer is, you're getting 60%. Okay, so this stuff is all written down on the test and quiz information tab, but I'm well, not the navigation thing. Sorry, I'll put that in. But the how many attempts you have and which what points are being lost and stuff. All of that is there, and the time and so on. And again, I know I'm a stuck record, but I will get like frantic emails from people. It's bound to happen, that you cannot leave the quiz or the test and go and do the laundry or something and come back and think that the clock was paused for you. Once you start, you got to finish it in the time allocated. Otherwise, you won't have extra time. And it is incredibly hard, almost impossible in this new Wiley system for me to restore someone's time or restore their test if they got locked out and stuff. It took days for one student, and it was still unclear to me and the Wiley rep why we couldn't get the students' test to I guess reinitiate. And so I don't want you to be in that situation. As much as the new Wiley Plus has been like around for I think at least 2 years, if not more, it seems that Wiley is also still sorting out kinks in their situation. So please plan to work on a browser that generally works for you when you do Wiley homework. Work on a computer that's not going to die in the middle of the situation. Clear your cache before you even start, the test, so that you don't end up having issues. Make sure that pop-ups are allowed on the Wiley website, because sometimes the fact that the thing wants to pop up maybe to give you some type of notice and it's being blocked will also cause a problem. Make sure that your internet connection is stable and that things are plugged in, and that you have all the materials that you need when you start. You don't want to be running around looking for formula sheets or things when you already started the test. Okay, so that's the information that I got from Wiley. I know this is still seemingly a ways away, but it's actually next week Tuesday when the window opens. Next week Tuesday is also when the chapter 14 homework is due. So it's Tuesday now. A week away sounds far away, but I know you guys also have other midterms, you have other things going on, you have life going on, most people work. So please plan how you are going to be able to finish this homework. If you haven't even started yet, maybe see how many questions there are and see how many you can do per day. I have looked at the schedule and we're in pretty good shape. So I was thinking that I'd probably see about let me just think now, maybe on the 26th, I just got to see the dates. On the 26th, I think some people are asking about a review. I might be able to do like a 1-hour review. I just want to be clear that the review is not me reteaching stuff and so on. We'll try and make it so that it's as useful as possible in terms of highlighting the difficult things and trying to practice some examples. Okay, so I'm not going to re-lecture everything. All right, so that's what I have to say about that. Anybody have a question on anything? Okay, so today we're tracking a little bit ahead, as you can tell. You guys are doing great. I guess that's on you, that, or maybe you are lost, but they're not saying anything. I don't think so though, judging by the results on the homework and so on. But we're tracking a little bit ahead, so I'm still going to carry on with chapter 14. We'll finish chapter 14 today. I'll definitely start a little bit on chapter 15, but what will end up happening is here Thursday the 28th, we'll lose part of this session because I will review the chapter 14 homework. Remember, just because the window opens on the 26th for the test doesn't mean you have to do it on the 26th. You can wait if you want to and hear me review the chapter 14 homework with you guys before you start the test. As long as you have finished what you need to do by November the 2nd at 6 p.m., you can do the test at any hour of the day or night that you want to do it. I just want to be clear though, that if you decide to do the test in the middle of the night, I'm not going to be able to respond to cries for help because you got locked out of Wiley or whatever in real time. It's just not possible. And just so you also know, I teach another class on Mondays and Wednesdays at this time. So if that's when you decide to do the test and you end up having a problem, I would not be responsive Monday and Wednesday from 10 to 2. So if you do get locked out or if something goes wrong, I will respond to you eventually, but it may not be within like a minute from when you send me the email. So please don't panic. I'm not ignoring you or making you suffer in silence or whatever. It's nothing like that. I just also, like most of you, have other things going on. All right. So going back to chapter 14, we finished up on all this retained earnings work. So I'm not going to go back into that. We did a whole lot of calculations of how to get to this document is available, obviously, how to calculate retained earnings. And that's kind of concluded. And what we'll do today is a stockholders equity analysis, specifically return on equity calculation. And then we'll also do the income statement preparation, which is kind of wrapping up the chapter. All right. So this will come up in much greater detail in chapter 18 of this class when we do a whole chapter on financial statement analysis. But what we're going to look at here just for a brief moment in this chapter is what we call ratio, return on equity. And basically what it's showing is, and I kind of spoke about this a little bit last week, but I'll just repeat because, last week when Thursday feels like ages ago. Basically, it's an investor is asking the question, what percentage did I make on my investment? Like, what did I make on my investment in this company? Now, obviously, you can say it in whole dollars. You can say, oh, you made, and that would be earnings per share. You can say you made $5 per share that you hold in the company. And I mean, that's nice to hear, but it's still a little bit unclear as to whether that's good, bad, or indifferent. So an easier way to be able to see what you made on an investment and then compare it across other options, right, of where you could have put your money, because you do have options. You don't have to invest in this company. You could have put your money in the bank. You could have invested in some partnership, or you could have invested wherever. So the best bet is to use percentages to compare, because dollar amounts become somewhat meaningless. Like saying, oh, if I invested in, Peloton, I would have made $3 per share. But if I invested in, the bodega on the corner, I would have made $20,000. But that doesn't tell you off of how much, like, how much money have you invested, how profitable was the company, blah, blah, blah. Like it's hard to to line those up and kind of saying I'm comparing apples to apples, right? As the saying goes. Whereas if you come up with a percentage, you say, oh, I invested in Tesla and I, have a return on equity of 10%. Now that percentage you can compare to if you invested in the bodega, I would have returned 12%. If I had invested in the bank, I would have returned 0.0%, etc. So the return on equity is helping us to come up with a generalized number, a percentage that we would be able to then use to in decision making, dialogue, and so on. And what we're doing here is analysis. Analysis just being that you've now calculated the numbers, you've come up with them, and now you are looking deeper into them to say, what does this actually mean for the question that I'm asking? The question being, how profitable is this company for my purposes? So, just looking at the theory, the ROE, or return on common stockholder, and remember it's common stockholders equity, we already know how much the preferred stock returns because their return is expressed as a percentage with the dividend. That's what they're getting. They don't have the net income attributable to them. It's just that dividend percentage that they have. So we already know what that is. So return on common stockholders equity indicates how many dollars of net income the company earned for each dollar invested by the common stockholders. And so it's calculated as net income minus the preferred dividends, because like we said, the preferred stockholders have to be paid first. Whether the dividends are declared or not doesn't matter, as long as there's a preferred dividend that might be paid at some point. You have to deduct it because it's only the remainder that's attributable to common stockholders. And then an average common stockholders equity, the average year, and this will come up, and it's come up, I think, with us maybe before. Average common stockholders equity, and average just means the beginning number plus the ending number divided by 2. Okay, so when we do the example, I'll show you. So the beginning number plus the ending number divided by 2 is how we do an average. And part of the reason that we use the average number and not just the ending number is that sometimes, fairly dramatic changes happen in the stockholders equity accounts between the beginning of the year and the end of the year. So we want to be sure that we are capturing, all of that change and not just having some big number at the end and using that as the only basis for our investment. All right, so that gets us to example 10, unless anybody has a question. Okie doke. So example 10 or exercise 10, let me just scroll down here. So this is Walt Disney Company's beginning and ending stockholders equity were 31,820 and 37.53 million respectively. So let's just stop there. First of all, they just gave us the numbers that we need for the average, right? Beginning and ending. They're not saying common stockholders equity, but if you read on, you can see that there was no preferred stock outstanding. So that, yeah, it says no preferred stock outstanding. So this means that all of the stockholders equity is related to common stockholders. So you don't have to worry about, taking out any piece that is for preferred stockholders, because remember the formula says average common stockholders equity. And then this million business, right, 31,820 million. So that's basically 31 billion. But because these numbers are all expressed in millions, when we do our calculation, we don't have to add the extra 6 zeros because you're going to come out with the same answer anyway. And adding a whole lot of extra unnecessary zeros onto your calculation could end up with you making mistakes. So you'll see that I'll just take the first 5 numbers and leave the 6 zeros alone. They're not necessary in the calculation. Even the net income is expressed in millions, so it's obviously billions. And that's what we need for the numerator, because there's no preferred stock. There's also no preferred dividends. So all of the net income is attributable to common stockholders. So I'm being asked to calculate the return on common stockholders equity. And so if someone wants to take a picture of this or whatever, just take, 10 seconds and take a picture, because I'm going to move onto the solution sheet here in a minute. All right. So example 10, and again, as I said, when we get to chapter 18, which is the last chapter that we'll do together, we'll also do lots of calculations like this. So this is going to be the return on common stockholders equity, and ROE is the abbreviation for that. And so it's net income minus preferred dividends divided by the average common stock. I'm just going to make it a little bit shorter so I don't have to keep typing out long words the whole time. And that's the formula as previously discussed. So now you're going to just take the numbers straight off the question, right? So net income is 4687. There's no preferred dividend, so you just leave it blank. Or you can say minus 0 if you just want to remind yourself that you should look for preferred dividend. Over here on the side, in fact, I'll just do it here. You can do average common stockholders equity. So it's beginning plus ending. And I should put this in brackets, beginning plus ending divided by 2, all right? So the number is, for the beginning number, 31,820. I'm just typing it out first so you can see, and then afterwards we'll just get to the actual number, right? So those two numbers added I was hoping that it would do. Okay, so I'll just do I was hoping that it would just do the formula for me. Can get the number. So 31,820 plus 3753 over 2. So that's the average, 31,286.5. And that's the number that you take over there. And you still, this is still a ratio. So it's one number in relation to the other. So then you take the net income divided by that. And so that's what you get. And that's not the answer yet, because this number is expressed as a percentage, 14.98%. So what does this mean, right? Because, we're not really accountants if we're just saying, oh, here's the number, okay, bye, right? If someone's going to ask you, what does this mean? Then you say, for every dollar that common stockholders invested in the business, they earn approximately, I'm going to just round it, 15 cents of net income. That's what that means, right? Your net income, you're getting back 15%. So for every dollar that you put in, you're getting back 15 cents, or 15%. Is that great? I don't know, right? In order to determine whether this is a good return or not, the investor would have to compare it to the prior year. These are all the things that you could compare it to. The expected return, returns on other investments, etc. Right? This doesn't happen in a vacuum. If I decide to invest in something, I would be wise to, actually consider other investments as well, and not just say like, oh, someone came knocking on my door and told me, invest in this scheme or whatever, and you'll get, 20% return. In fact, if someone said that to me, I'd probably say it sounds too good to be true. And this is kind of like the life lesson portion of the class. When people come with their schemes and scams and stuff, over the past, like just over 100 years or so, I mean, I know the stock market's been going nuts recently, but the stock market kind of goes up and down. And so the average return on the stock market over time is somewhere in the 8 to 10% range. Now, I know that even in, I think it was 2019, 2020, it was somewhere more like 30%, 30, because I was watching, my portfolio, I was watching my kids 529, and I'm like, okay, this is going nuts. But remember, and you've seen this almost like every 10 years, there's some massive crash, unless like what's happening now, the Fed is artificially propping up the stock market. I mean, the Fed is buying back so much stuff. It's happening all in the background to try and keep the stock market and the economy going. Whether that's right or wrong is a debate we can have in an economics class, which I don't teach, but I'm sure you can have it with your other professors. But the Fed is keeping the stock market up. Ethically, you should ask yourself, does it make sense to do that when, the Wall Street will always benefit, but what about the rest of the people on what they call Main Street, like normal people, small businesses that couldn't get PPP loans because they don't have a good relationship with a bank and all of that? I mean, I'm going to go off on my tangent, so I better stop. But the point is, the stock market returns maybe somewhere between 8 and 10%. So if someone comes to you, Lawrence or Andrew, Michelle, whoever, Denise, someone comes to you and knocks on your door and says, hey, I've got the best deal ever for you, and you'll be able to return, 20%, no questions asked. You really do need to ask questions, and you need to figure out what on earth is the basis for making that much money, because something like that is basically you're doubling whatever has been earned in the market over many years. Now it's like, oh, I've got this great stock pick for you or whatever. Do your due diligence. Make sure that you understand what the business is. Make sure that you understand what the trend is in the stock and so on before you just dump your money into something. And because you have no recourse, I mean, you're making a decision to invest in something. You can't go running back to the person and saying, oh, I lost my money. And then if you want to go and sue them, you go to small claims court, you're going to pay more for the lawyers than what you'll ever get out of the person. So 15%, is it good? Is it not good? It sounds pretty good in this low interest rate environment. Sounds pretty good to me. But if I had to tell you that in the previous year, Walt Disney's return on equity was 20%, then you'd say, oh no, this is actually going down. And then as a good accountant, you will go in and try to see why the number has declined and so on, right? So we don't just calculate this number in a vacuum and say, oh, 15%, well, that's the answer. I'm done. You're asking, is that a good, is it a good number? Is it not a good number? Compare it to other things, right? Compare it to other things. So that's the calculation of the analysis of stockholders' equity, specifically in the context of return on equity. Does anybody have questions or comments, concerns about this calculation? Okay, so I will move on to discuss the income statement so that we can wind our way down to the end of this chapter. So we already know what the income statement is, right? It's it's showing over a period of time all the revenue, expenses, gains, and losses, right, of the company. And we had said already many times, and I'll say it one last time, that for a corporation, the main difference here is going to be that you'll have an income tax expense line item. For partnerships and sole proprietorships, you do not have an income tax for the entity. It's going to be the owners that will pay the tax, right? They all flow through entities. The money flows through the company to the owner, and the owner pays tax. So if you ever hear that terminology, flow through, that's what it means. So income statements for companies are similar to proprietorships and partnerships, but we know that they are separate legal entities, so there's tax. And the journal entry to record the tax, nothing, really groundbreaking here. You just recognize the expense and you recognize the payable. Companies generally pay, depending on what the tax situation is, but in general, they pay quarterly taxes to the IRS. And so then by the end of the year, when they actually file, maybe there's some extra to pay or whatever. It's fairly complex. A lot of the companies, their tax situations are so complex. I remember when I worked at Deloitte, we would have groups of my colleagues like at certain companies for almost the whole year, just working on taxes, like auditing and figuring out, tax situations, so that the company would be ready to file taxes every quarter, and then obviously at the end of the year. So it's a lot of work. If you if you go into tax, maybe doing a master's in tax or something, you would be highly sought after. There's always a lot of changes to the tax code. It's very complicated. There's a lot of work available. You can also have your personal tax practice, so it could also be very flexible. But I mean, you have to know your stuff, because if you're filing with the IRS on behalf of people, you can't, mess up their taxes. So it's a lucrative profession, but it does carry some risk, of course. Just because you're an accountant, doesn't mean that you're a tax expert. Like I'm an accountant, so people always ask me about tax, and I'm like, yeah, I know about tax, but like to do my own taxes, not because I spend all day doing taxes. I actually spend all day, doing accounting. All right. So let's look at number 11. I mean, that's literally the preamble to income statements, because you guys already know, right? A multi-step income statement from accounting one. I know you remember how to do that, right? Or not, I guess. And I'll just show you how to calculate. We'll focus on how to calculate the taxes. So let's look at number 11. The following information is available for Ranch Corporation for the year ended December 31, 2018. There's a cost of goods sold of 205,000. That does belong in the income statement. It's an expense, right? It's the expense that relates to the inventory that was sold, so that we can show the proper gross profit. Sales revenue, obviously revenue goes into the income statement. Other revenues and gains, so that's, that other stuff I was talking about, like gains and losses. It's non-operating. It's not part of the company's day-to-day, but it should still go into the income statement. I'll show you how to present that. And so it's only revenues and gains. There's no expenses and losses in the other category. And then there's also operating expenses, which is your day-to-day expenses of 75,000. Assuming a corporate tax rate of 30%, and this is kind of obviously older now. I'm not sure that the textbook changed, but I think you guys know, or you may have heard, with Trump's presidency, and I won't editorialize on that, but with Trump's presidency, one of the first things he did when he did that, like the Tax Cuts and Jobs Act, that was his signature move. They cut the corporate tax to like 21%. Because they believe in trickle-down economics, that if they stimulate the company, then supposedly the company will pay their workers more, and all this money will trickle down into the economy. That's been proven to be false, because when you stimulate the company by cutting the taxes, all that happens is either the companies hold on to their cash reserves, which most of them have. They've got billions, tens of billions in cash. They're not all suddenly paying their workers all kinds of extra money, or they pay the executives more money. I think I think there was a little bit of pressure on Amazon, and I think they maybe increased their workers' pay by about $3 an hour. I know that they're paying people's tuition, so is Starbucks. And there was a company, I think it was Patagonia, when the taxes were cut, they got a massive, tax refund. They actually gave each employee $1,000. But, if you look at wage stagnation over the years, the tax cut, and even now we're like, what, 5 years out of the tax cut for companies. People are resigning en masse. I'm sure you guys have seen this thing about the Great Resignation. People are resigning en masse because of working conditions and pay. So this notion that that the cutting the tax rate to 21% has miraculously changed the way companies view their employees is just a fallacy. Where we have much bigger problems than that. A tax cut is not going to trickle down very far. But the tax rate for the US companies is much lower now, even though many companies were never even paying 30%. Some companies, I remember one time I looked at a company's financial statements, I think it was Pfizer, this was years ago, they were paying an effective tax rate of 11%. And my effective tax rate at the time was 15% of my income. So you can imagine that sometimes individuals are paying a higher percentage of their income to the IRS than corporations even are. And I mean this, I'm not trying to be I'm not like down on companies. I mean, this is the business that we do. We just always have to look at things with open eyes and realize that everything is not always what it seems, and decide how we want to participate in that. So take a picture of this if you want to hold the question close by as I go through the answer. I think the answer you'll find is not going to be too difficult. So example 11, it's an income statement. So Ranch Corporation, right? It's an income statement. If you remember, an income statement is for a period of time. So you're looking at for the year ended. Sometimes in the Form 10K, which is the annual report of companies who are listed on the stock exchange, they'll call the income statement the statement of operations. It's the same thing, okay? Statement of operations, income statement, it means the same thing. So this is for the year ended, my typing is awful today. For the year ended December 31, 2018. Remember, in contrast, the balance sheet is at a point in time, so we'll just say December 31. The income statement is for a period of time. It's like a video or a movie that's rolling. The balance sheet is like taking a picture, a snapshot at a point in time. All right, so we start with the good news. As usual, we say sales revenue. Tell us, right, how much you made. So it's 350,000. This is what we refer to as a multi-step income statement, because there's a few additions and subtractions before you get to net income. You don't just have sales minus expenses is net income. So multi-step from your chapter 5 in accounting 1, right? If you still remember that. So you're going to go less cost of goods sold, which is again an expense. So it's a subtraction, 205,000. And so this becomes the first step, right, of the multi-step, is going to tell you that this is gross profit. And so that number is 145,000. I'm typing it in because if I do this calculation, it's going to bring the dollar sign down. From there, you want to deduct remember, this has all got to do with the day-to-day operations of the company. So you want to deduct the operating expenses. You don't want to do anything with other revenues and gains at this point. So the next step of the multi-step is to deduct operating expenses at 75,000. Right, so there's a line again, and this is what I mean about these steps to get to net income. And now this becomes income from operations. So it's saying just from the day-to-day business that we do, right? This is how much we made. And we separate this out in the financials because we want a level, we want users, readers of the financials to be able to see a level of predictability of what this company is capable of generating just from their regular business. Because if they get some windfall, they get a whole lot of money from somewhere, but it's only for this year, we shouldn't be thinking that that's going to happen every year, right? So that's why this other revenues and gains is going to be separate, and it's after income from operations, so that someone reading the financials can say, oh, this is a nice chunk of money, this 50 grand, but I can see that the 50,000 is not expected to happen again next year because it is marked as other, sometimes also called non-operating, right? Revenues and gains, but in this case, we just call it other. So this 120,000 will be tagged as income before income taxes. If we had been in our sole proprietorship, that would be net income, or in the partnership, that would be net income. Income before income taxes. So 120,000 is the amount that the income tax is based on. We know that 30% is the tax rate, so you can already do the math in your heads, right? The income tax expense is going to be 36,000. So income tax expense is going to be the 120,000 multiplied by 30%, which is 36,000. And so now you come to your final line item, which is going to be net income. And this obviously is subtraction, right? Income tax expense. So, oops, what did I do wrong here? Let me make sure. Oh, I'm looking at the solution and I think just one second. I have no idea what happened here. I might need to make sure that the solution I gave you guys is right, because for some reason that solution says a totally different number to what I arrived at. So let me just audit my work and make sure I didn't mess something up. So that expenses, yes, yes, yes. Okay, is there anybody who disagrees with this answer or has a question? Speak now. You don't have to forever hold your peace, but speak now before we move on.
That's what I wanted to ask you from the beginning. It's the last question in the homework, because I got a little confused because the way we learned income statements is that first you do revenues and then you do expenses and then you get to the net income.
Yeah, but that's a single step income statement. You would have learned that I know what you mean, but in that's one type of income statement. But then I don't know if you did accounting one at LaGuardia, if you did it out of the same textbook. I'll show you when I go over the homework with you. In chapter 5 of the textbook, they'll teach you a multi-step income statement. Sales less cost of goods sold is gross profit less operating expenses. This is multi-step. The one you're referring to is single step.
So the reason you chose this order is because first you do the daily operating revenues and expenses, and then after you add the others?
Yes, yes. You always first show what is generated just by opening the doors, just by being in business. And then you add the things that are unusual that wouldn't be expected to recur all the time. Yes. And then you do income tax.
So does it matter if you do cost of goods sold or operating
It
expenses?
matters. It matters. These steps are set. Everyone, or
What
I
did
mean,
cost of goods sold first?
yeah, everyone wants to know. I mean, by everyone, it's like, interested parties want to know what gross profit the company is generating, right? Because that's telling you how much of your sales revenue you actually get to keep to cover the rest of your expenses. So you don't want to be taking off operating expenses over here. You first want to tell me the gross profit and then you take off the operating expenses. And to get to gross profit, the sales less cost of goods sold.
So it always goes by this order.
This is the order.
Yeah. Okay. Yeah.
It's set. It's pretty much set.
I forgot everything from chapter 5.
Yeah, I mean, I'm not even saying chapter 5 to thinking, because trust me, I can barely remember what happened, 2 weeks ago. I don't expect I'm not saying that people remember chapter 5. I'm saying that if you wanted to go back into the textbook to see what I'm talking about, it's in chapter 5.
Yeah.
But
I'd
it's
look
also,
through it.
but it's also,
Usually use
it's also in,
summary.
it's also
So
in chapter 14. So, I mean, you don't have to go back to chapter 5. It's just that sometimes things ring a vague bell and it's like, wait, I feel like I saw this before, but where did I see it? And so that's the original source of this. And so chapter 14 is working under the assumption that you've already seen this in chapter 5. Because it's
okay,
the same
I'll
textbook.
go over it. Yeah, I have like summaries of each chapter that I usually make by
Okay,
myself.
all right.
I'll go to chapter 5.
Yeah, and when we go during the break over your work, I'll show you because there's normally one illustration that shows the whole thing in that chapter. Yeah,
Hmm.
so if
Good.
anybody who downloaded the solution of this question, from the Zoom materials, for some reason, I have a totally different net income ending number on the solution sheet. So I'll fix that. And if you want to load it, I don't know. It seems like some type of gremlin came in and messed up. I can't even figure out where that number comes from. I'll have to look at it. All right. So that's the income statement. And just like C was saying now, right, there is a homework question. I think there might be 2 homework questions on the income statement. So yeah, there will definitely be, or there is already an income statement on the test. So please make sure that you understand the logic here was just what I was saying to her and what I was explaining, that this is a multi-step income statement that has to move in this order to eventually end at net income. All right. I'm going to just push us to do the earnings per share calculation, and then we can take a break, because earnings per share is actually going to be the end of this chapter. So it's a little bit choppy to take a break now and then come back and just do one thing in chapter 14. So now that we've gone through an income statement and seen, how it's different, and again, it's really just these 2 things that are different. Everything else, I know you forgot probably, but everything else you've seen before. These are the only 2 things that have changed between what you were doing in accounting 1 and now. So now that we've gone over that, we also have an opportunity to analyze the income statement, just like we had an opportunity to analyze stockholders' equity. And the way we do that is with earnings per share. That was what I was referring to earlier, when I said how much money did you make per share that you have in the company. So, if I look at this 84,000 and I'm an investor in the company, that's nice to see that they made 84,000, but I want to know how much of that, quote unquote, belongs to me, even though I won't get it until the dividend is declared. So how much of this belongs to me depends on how many shares I have, right? Because it's proportional. So a convenient measure of earnings is earnings per share, which indicates the net income earned by each share of outstanding common stock, outstanding being outside the company, not including treasury stock. Pardon, EPS is reported for common stock only, and that's because, again, the preferred stock already has their dividend set as a percentage, so whatever they're going to get is known. The earnings per share is for common stock. When a company has both preferred or common stock, and common stock, we must subtract the current year's preferred dividend from net income, because that's attributable to the preferred stockholders, so that the income that you're working with, it's just like what we did up here, right? For return on stockholders' equity, we also deducted the preferred dividend, because you want to make sure that the net income that you're using in the calculation is relating to common stockholders only. For this example, for instance, we don't know, right, if there's preferred stockholders, but if there were, we would say 84,000, we'd subtract the preferred dividend first, and then we would do the calculation for earnings per share. So here's the earnings per share formula. Net income minus preferred dividends divided by the weighted average common shares outstanding is earnings per share. So normally the question either gives you the weighted average common shares outstanding, or you will just again do the beginning number plus the ending number divided by 2 for our purposes. Okay. For those of you who are carrying on with accounting, the number gets a little bit more complicated later on in your lives. But for our purposes, the number is either given or it's just an average, simple average, beginning plus ending divided by 2. So when you're preparing for, when you're doing the test or whatever quiz, make sure that you have this a formula near you. If we were in class, I would have given you a formula sheet. Okay, so don't assume that you're going to remember this. You don't have to memorize it for my purposes. You do need to be able to calculate it. Okay, I'm less concerned about people memorizing things and being able to regurgitate a formula than actually knowing how to use the formula. So we'll do example 12 before we break and see how this formula is applied and understood. So assume that Rally Inc. reports net income of 211,000. So there's one component of the calculation on the 102,500 weighted average common shares. So the question gave you the weighted average, so you don't even need to do beginning plus ending divided by 2. During the year, it also declares a 6,000 dividend on its preferred stock. So this is different from the previous analysis that we did where there was no preferred dividend. Here there is in fact the preferred dividend. Calculate the earnings per share for common stockholders. Okay, so you have an answer. I'll see if I am getting to the same number. So just start out by writing out so net income minus preferred dividend divided by the weighted average common shares outstanding. Okay, I'm just going to make some abbreviations here because you've got access to the formulas on the sheet, right? So net income was 211,000. So I'm going to say 211,000 minus, right, the 6,000 preferred dividend, right? And they gave you the weighted average, so you didn't even need to do anything else, 102,500. Okay, so if you were doing this, as a formula in Excel, just making sure you would just do that. So you come out to 2, if we check, so it's basically 2, right? On the dot, seemingly. Oh, I'm not sure. See, you were saying 1.9 something, but I seem to be arriving exactly at 2.0. I don't know if
so I had a mistake. I changed it later.
okay. Okay, no worries. So 2.0 is the answer. So what does this mean? I will always write. So it's $2. The way you express it is $2 per share, right? So what does this mean? You can already guess. For every share that the investor holds in the company, they earn $2 in net income. And I should be more specific, investor, common stockholder, okay? Because investor could also be a preferred stockholder, and that's not true. That the common stockholders in that they earn $2 in net income. Please, I'm just going to write here, please note that this is not a dividend unless it is declared. Okay, so you can't say that they're entitled to $2 of dividends or that they're going to receive $2 or whatever. For that to happen, they actually have to declare a dividend. This just means that for that year, you earned $2 per share. And now you will wait and see if the board of directors decide to actually declare a dividend or not. And unfortunately, you might wait, you might earn a ton of dollars per share, but you might wait forever for any dividend to be declared. As we know, a lot of the companies just hold on to the cash and say that they're doing research and development and they don't want to pay out the money. All right, any more questions? Well, not that there've been a ton of questions, but any other comments here before we take a break? All right, so the clock's probably going to turn over soon. So let's come back at 11:50, 11:50. At which point I'll start doing the introduction to chapter 15. All right. 11:50. And C, do you need me to still answer something for you, or is your question actually answered now?
I think it answered. I mean, the one thing I wanted to ask you, it was about the income statement. But if I'll kind of like go over the question we did in class, it will be enough, no?
I mean, maybe just going to Wiley, and because I don't actually know what your question is, so maybe it's just better if I go into, gosh, what on earth is going on? Sorry.
Now it makes sense for me because I finished the homework before class, and all the the last part of the homework, it was all new information for me that I tried to like figure out while I was
Oh,
doing
yeah,
homework.
because we hadn't done it yet. You
Yeah,
mean yeah.
now everything is like after class, I'm like, oh, now it makes sense.
Okay. I understand now. So it's probably gonna be fine then. But we'll just, which one was it?
The
This
last one.
one?
Yeah.
Yeah, so this is pretty standard, what we were just doing. Yeah, so cost of goods sold, gross profit, operating expenses. Yep. The only difference here is that you also have other expenses and losses. So the revenues and gains get added to the income from operations, and the expenses and losses are subtracted. And then, so this is really the only line that's different, and this would just be a subtraction. And then income before income taxes is just going to be this number plus the revenues minus the expenses gives you this number. And then income tax is a percentage of the income before income taxes. The percentage is 20%. So they've adjusted the textbook for the change in tax rates. So it's a 20% over here. And then you subtract the tax from this number to get to your net income.
Mhm.
So I think your issue was over here, whether you needed to put cost of goods sold or operating expenses. That's what it sounded like to me.
Yeah.
Right. Okay. All right. I think we're good then. Okay, folks. Maya, I thought I saw your hand up at some point.
Hi, Professor. I have
Hey.
a question about number 6 for the home. For
Oh, okay. Hang on. Let me go back. All right. Go ahead.
For some reason, I kept getting it wrong. I'm not sure if I did the calculation wrong, but my question was for Kane Corporation. I don't know why, but like for the
Wait, A or B or both? But you want me to walk you
for
through it?
A and B. Yeah, because I got the titles correct, but the calculation was wrong.
So is it easier for me to walk it through here, even though I have different numbers to you, or do you want to share your screen?
No, it's okay. You can
Okay,
walk it through.
okay. So on January the 1st, Sunland Corporation this is the common stock dollars outstanding that was issued at par. It also had retained earnings of 749. The company issued 43,500 shares of common stock at par on July the 1st and earned net income of 390,000. So, okay, so this is already going to be a little bit tricky. So I'll go slow. Generalize the declaration of 14% stock dividend. That's fine. So firstly, they give you two different par values, right? Two different scenarios. These scenarios are obviously independent of each other because the stock won't have, two different par values at the same time. So we'll start with this one, right? The par value of $10 per share. So the first step that you need to be thinking about is when you have a stock dividend being declared, you need to know how many shares are outstanding on the date of the dividend. All right.
Yeah.
So on December the 10th, how many shares are outstanding? You can't tell from this because it's in dollars, how many shares that relates to. So what you need to know is to get from this dollar amount to a number of shares, you basically have to remember that the common stock balance is calculated as the par value times the number of shares outstanding. So you have to divide this in my case, 1,270,000. I divide it by 10. I wonder if they show this in the solution. Because let me see. Yeah, they do. So this beginning number over here, whatever number you have, right, has to be divided by the par value to get to the number of shares over here. You can see they do it to get to the number of shares that are outstanding on January the 1st. And then to that number, in this case, it's going to be what, 127,000, right? And then to that number, you will add the extra 43,500 shares, because that's being issued on July the 1st. You got to watch the dates here. Your stock dividend declaration is only on December the 10th. So you want to know, what did I have outstanding in terms of shares, not dollars, shares on January the 1st. You take this dollar amount divided by the par value, and that gives you a number of shares. To that, you add the extra shares that were issued on July the 1st. That gives you a total number of shares that are outstanding on December the 10th. And that number you multiply by 14% to get to the number of shares in the stock dividend.
Okay. I see where I went wrong.
So in my case,
because I just multiplied the, hold on. I did this, for my question, I got 42,000 shares, and then I multiplied it by the percentage.
The 42,000 from July the 1st, you mean? From the, are you saying you took this number over here and multiplied? Yeah. So you forgot that there was shares already outstanding, that you needed to take this number and divide it by par value to figure out how many shares were already outstanding at the beginning of the year.
Okay.
And the same applies to the B. It's just a different par value. You would then just take this number again and divide it by 5 instead of dividing it by 10 to get the number of shares, and still add the 42,000 that you have in your question to that number.
Okay. Okay, I understand.
All right.
I see where I went wrong. I didn't add the already outstanding.
Yeah, so I think the rule here for most of us would be that unless the company is just starting, which this company isn't, there's probably going to be shares already outstanding. So you have to figure out on day one how many shares are there. And then if there's additional shares issued during the year, you add those, and then you can calculate your stock dividend.
Okay.
Okay.
Thank you, Professor.
Good. You're welcome. Anything else, people? Okay, so just bear with me. I'm just going to leave my desk here for a second. I'll be back at 11:15. Just making sure that I have everybody's attendance and then we can carry on as soon as I'm done with this. I'll only call out names for people that I don't see on the call. So if I don't call your name, don't panic. It just means that I see you. Is Zanetta on the call? Zanetta Ramcharan? Oh, Margaret Rodriguez? John? All right. I have everybody else. Thank you.
Did you call my name, Professor?
Sorry, who's speaking?
Lewis?
Oh, I already have you. I was only calling names of people that I didn't see on the call, just to make
Oh,
sure that I wasn't missing them. You're here. I have
oh,
you. Don't worry. All right, so we're done with 13 and 14, which, as you know, form the basis of the first test. Corporations, right? Corporations issuing stock, and then also the dividends, retained earnings, and income reporting. So we're for the next part of our work, we'll kind of switch gears here a little bit to away from what we call stockholders equity type of work towards liabilities, right? You remember on the balance sheet, you have assets and then you have liabilities and stockholders equity. We've been doing a lot around stockholders equity. And so we're going to look in this chapter at long-term liabilities. And so, in starting this, I will just say that I guess a way you can think about this chapter or this chapter in relation to the other chapters that we have been dealing with is that a company can raise money, I guess, in multiple ways, but it's really just ultimately two ways. They can either, issue stock and raise money by, giving away parts of the company to people in return for some cash or assets or whatever that they give them back. So that's what we were doing in chapter 13, where the company issues stock and they get cash or other stuff in return. And that's a way to raise money. That's why you see like some of these IPOs, initial public offerings that companies have. Often it's a way for them, the business is growing, they maybe have taken out loans and stuff, but it's maybe a way for them to get more funding so that they can grow the business even more. So, that's the equity side. But then there's also the debt side, right? You can also, like, if you had to start a company, you could ask, you could have someone invest. Like if you think about like the classic Shark Tank scenario, right? Someone invests, but they want a cut of the company. But maybe you don't want to give away the company, but you still need money. And depending on, I guess, if it's your personal company, your credit score, if it's a corporation, they also have a type of credit ratings and so on. They may go and prefer and go in for debt, right? To borrow to raise funds instead of doing it through equity. And that's fine. It's another way of getting cash. But yeah, I have everybody's attendance, Sam, don't worry. Everybody who's here, there's like 4 people who are not here, and I called them out and they didn't respond. They're not here. I haven't seen their names, so don't worry. Everybody else is in attendance. So yeah, the long-term liabilities, when the company raises money with debt, you can imagine that there are some benefits to that and obviously some drawbacks, right? So just in relation to what I was just saying, a benefit of doing debt, a liability, raising money through a liability instead of through equity, is that you get to keep 100% of the business, right? So you're not giving parts of the business away, which then in a way entitle people to some piece of the profits. So that's nice if you want to make sure that you are keeping control of the business. On the flip side, with the debt, is that you probably have to pay interest on the debt. So that's an expense that you will have to be able to cover regardless, of whether your business is struggling or whatever. You are contractually obligated to pay the interest. Remember, with equity, you don't have to pay dividends unless they are declared. So, I mean, if things aren't going that great, you just don't declare the dividend and you don't have to worry about, cash flow situation. With debt, unfortunately, the interest is not going to go away. So you're going to have to find a way to pay the interest, even if, even if the business isn't doing as well as you'd hoped. However, a benefit of interest, a kind of tangential benefit of interest, is that it's tax deductible. So at least you get some tax savings. Dividends are not tax deductible. Dividends are not an expense of the business. They're just a distribution of net income. So even though, with debt you pay interest, you can at least still deduct that interest on your taxes. I mean, if you have student loans and you do your taxes, you also see that if you're paying the interest already on that, you see that you can deduct that interest even on your personal taxes. So interest is tax deductible, right? So if you think about a company that decides to issue stocks instead of debt, they'll have a very different looking balance sheet, right, to a company that decides to borrow in order to, continue in business. So in this chapter, we will go through different scenarios of basically different types of debt. Let me close this thing. Different types of debt that a company could be using in order to raise funds. The first thing that we will look at is bonds. A bond is just, again, a name for a debt instrument. It's basically the company gets money from investors and pays them interest, and at the end of whatever the life of the bond is, they will pay, the company will pay the investors the full amount of the bond. And so we'll go through a little bit like issuing bonds and so on, and continue like this. With this bonds, it goes on, like you can sometimes sell the bond or sell and issue the same thing, sell the bond at a premium, at a discount. when you pay the money back by you, I mean the company, when the company pays the money back, we call that redeeming the bond. So you redeem the bond before the time limit is up or at the time that it's due and so on. And then we'll also speak a little bit about notes payable and mortgage notes payable. If you own a home or if your family members own a home, you know what a mortgage is. Companies also take out mortgages, and we'll do some calculations around, how to split the monthly or the annual payment for that mortgage between interest and the actual debt that you're paying off. And then after that, nearer to the end of the chapter, we'll do again this, like what we just did, some analysis, calculations, and so on. So yeah, so what is a bond? It's just what I mean, in fact, if you let me go in here, right? It's an interest, it's just a debt, it's an instrument, it's a way that you can borrow money that is literally just written up that, like, I owe you so much money and so much interest. It's a type of, I mean, you can almost call it, I'm sure you guys remember notes payable, maybe not from accounting one, but it's a payable, it's a liability for the company, but it's a specific type of liability that often has a higher, dollar amount than just like, going and borrowing a little bit of money from the bank. This is more about issuing, like how we issue stocks to investors. We could issue bonds to people who want to invest in our company, but they want to invest in our debt, not in our equity. All right, so a note payable that is interest bearing. The company is using it to borrow money, and someone else decides to give the company money. So that person is investing in the company, but not through stocks. They are using debt. And let me show you, I think it's here in this. So a bond, I mean, this is looking very dramatic, and I'm not sure in this day and age of everything being electronic that this is necessarily something you'll get in the mail, right? If you invest in bonds, but this illustration is nice because it does show you what a bond represents, right? So we have this terminology like IOU. So in this case, International Minerals, and Chemical Corporation is the company that is giving the bond to the investor. All right. So this piece of paper represents something that the investor can come back and say, okay, in X amount of time, you got to pay me my money back, right? So International Minerals is the company that's borrowing. $5,000 is the amount, right? The bond, what we call face value being that it's like on the front of the bond written there. So 5,000 is what this bond is quote unquote worth, right? Before we talk about interest or anything. So the company is giving this bond, let's say, to Andrea Francis. Andrea gives them $5,000 and walks away with this piece of paper. And this piece of paper then says that in 2023, International Minerals will give Andrea the $5,000 back. Okay, so that's the benefit of investing in debt versus equity. If I invest in stocks, I can't, if I invest in my 5 or whatever puny little Facebook shares that I have, if Facebook tanks, some scandal happens and, Zuckerberg is all over the papers and the Facebook price plummets, the stock price plummets, I can go knock on Zuckerberg's door and say, hey, Zuckerberg, once upon a time, I invested, X amount of dollars in your company, and I've now lost like 3/4 of my investment. You better pay me back. He'll just, first of all, I probably won't even be able to get an appointment, but he'll also just laugh me out of California. Whereas if I had loaned money to Facebook, I can go to him and say, hey, this money is due. So International Minerals, they need the money. They issue the bond. Andrea Francis gives them $5,000, knowing that she will get this money back in 2023. And in the meantime, while she's waiting, oh, so that's, sorry, so yeah, May the 1st, 2023, that's the maturity date, meaning by that date, by or before that date, depending on the terminology of the bond, the terms, sorry, not terminology, I have to get my money back. So there's a level of predictability, right? 5.75% is the interest rate, the contractual interest rate that that they have to pay me. So it will say in the bond if the interest is semi-annual, annual, whatever, but the point is I am entitled, because of this piece of paper that I'm holding, I'm entitled to them sending me a check or depositing in my account 5.75% of this face value, right? $5,000 at whatever interval it said, you know, they're going to pay me, maybe every 6 months or maybe, you know, once a year, right? So this is a bond, and these are basically the features of the bond. Who's borrowing the money? How much is the issuer? How much money is being borrowed is the face or par value. How much interest is being paid is the contractual interest rate. When this money has to be paid back is the maturity date. And on the other side of this transaction stands the investor, Andrea Francis. She's given up $5,000, right? Her wallet is $5,000 lighter, but she's going to get interest from the company because they're going to use her money, right? So she's going to earn some return. Remember, we spoke about return as a percentage. She's going to earn a return of 5.75%. And then at the end of the term, the maturity date of the bond, she's going to get $5,000 back. Yeah, I mean, you can think of it, you're asking me, is it a loan? You can think of it as a type of a loan, but it's very formalized, right? As you can see, it's not just like, oh, you know, can you lend me some money? It's very formal. It's a specific amount of money with a specific maturity date, with you know, specific interest rate. So yes, it's a liability. In this case, this bond liability is a type of a loan that the company is taking out. But it's not like just going to your bank and getting a loan, right? Because they're actually issuing it to investors, you know, people like us, or, you know, other maybe bigger investors. I just want to be clear that you understand that this is not between the company and a bank where you would classically take out a loan. This is between the company and whichever investors choose to participate in this bond issuance. And sometimes what you can do, and this kind of, I hope that answers your question, see, what you can do, and this kind of approximates stocks as well, is that some bonds are traded on a bond exchange. So you might, you know, invest in this International Minerals and give them $5,000. And, you know, you're fine with it at that time, but then you start seeing that this bond is actually trading on the bond exchange, and the price is moving in all different directions. And the thing that will impact how the price moves is the interest rate on the bond in relation to the interest rate in the rest of the market. So say, for instance, this interest rate 5.75 is much higher than the interest that is being offered in the rest of the market, then a lot of people will want this bond because they want that high return. So as the bond is trading in the market, the price of the bond may actually go up above $5,000. So I can say, oh, you know, this bond has become like super popular and is now, even though I gave up 5,000 for it, if I sell it today, I'll be able to get 6,000 for it, but I'm giving up all the interest, right? But I'm willing to do that. So I can go, and this is in, you know, in your book, you can actually go and sell your bond, or you can go and buy your bond, and so on. And you know, they show us here in the book that Twitter, which I think we're all quite familiar with, that Twitter has, you know, has some bonds that are out there in the market. They have a contractual interest rate of 3.875%. Each bond has a $1,000 face value. They're going to have to be paid back in 2027. But you can see based on, and this, we can talk about this more, but basically the bond is only trading at $977, even though the value is 1,000. So, if you bought the bond, let's just say you bought the bond like a day, this was a day before maturity, you would pay $977 for it, but you would actually, the company would actually give you $1,000 when the bond matures. So you're making like a $23 profit in addition to the interest that you will earn. So again, a bond can be traded just like our stocks are traded. And the thing that drives whether the price is going up or down is often just what's the interest rate on the bond, what's the maturity date on the bond in relation to what's happening in the rest of the market. Okay. So what does this mean for us, right? You're sitting there, you're like, okay, fine, Professor, thanks, for the bond background. What does it mean for us? In this chapter, we will do a lot of journal entries around bond issuances, around calculating interest related to that bond issuance, around issuing the bonds for higher or lower than face value, and then also the paying back of this amount, right? Of the bond amount. We will do all the journal entries around, if the company decides to pay the bond back before the maturity date. So maybe this company decides that and if the bond is what we say callable, that they don't want to wait until May the 1st, 2023 to pay us back, because they realize that they're paying out 5.75%, but they could actually just go and get a bank loan that's only going to charge them 3%. So they don't want to keep paying out all this money to us if they can borrow in a different way. So then they might say that, as of tomorrow, they're going to pay back this bond before the time, right? Redeeming before maturity date. And we'll see as we go through our work what happens with that. You can imagine that if I'm holding this bond and International Minerals tells me today they want to pay me back, I'm going to say, but yeah, if you pay me back now, I'm going to miss out on all this interest, right? I don't want to miss out on all this interest. I was supposed to get interest until May 2023. So they will have to sweeten the deal, right? They'll have to give me some extra money to basically shut me up so that I'll be willing to take the early payment, and they'll have to calculate to see how much extra money that comes to. So this is the crux of what we're doing in this chapter. Sorry, this is not the right thing. What we're doing in this long-term liabilities chapter. But like I said, it's bonds, but we also, and maybe it's easier to see in the textbook, it is bonds as a major focus of the chapter, but there will also be some discussion on and some work around notes payable, but also quite a little bit of work around mortgage notes payable, because we will calculate what we call an amortization table that shows, again, if you've ever had a mortgage or you've seen, people paying their mortgage every month, that especially in the first 5 years of owning a home, the bulk of what you pay for your monthly installment for the mortgage is just going to interest. Okay, it's just interest. So so we will do the calculations so that you can see, in these textbook examples, which obviously aren't all the same as real world examples, but how much of the mortgage is being paid off every time someone makes an installment. This issue is also why, when the financial crisis happened, which was, long ago, like 13, 14 years ago, a lot of people just outright lost their homes with foreclosure and didn't get anything really back, because they were newer purchases that basically anything that people were paying had really just gone towards interest. So when the bank sold the home, the bulk of the mortgage amount was still owing, and people, they have to pay off the bank and didn't really get much back for themselves. All right, and we'll talk more about that when we get to the mortgage section. So at this point, I don't know if anybody has anything to add or questions or something that you want me to go over again as we kind of just prime ourselves for what's happening. All right, so I'll just go, fairly slowly through this. Like I said, we're tracking ahead time-wise, so there's no need to rush. And I'll see how far I want to take this before we end, okay? And so the way, this chapter opens, this is just, again, my summary notes that you can kind of just use as a quick reference for what's happening in the chapter. It just says again, in the previous two chapters, we were dealing with equity and the issuance of stock, and you kind of give, away a piece of the business and you get money in return. Now we raise money by borrowing in, through various forms, but we're not giving away any part of the business. And a small part of this chapter, which I didn't discuss, I should have pointed it out in the listing over here, is leases. I'm sure being New Yorkers, many of you are familiar with leases. So there's a little bit of discussion on leases at the end of the chapter. Okay, so what is a bond? You've already seen the picture of the bond. You know that it has interest. It's a type of note payable. They're issued or sold by companies, right? The company gives the bond and they get the money in return from various investors. The advantage, as I said, is that you don't have to give away part of the business, and interest is tax deductible, but you have to pay interest and you also have to pay back the money, which is a big ask, right? If you don't have the money when it's due. I mean, that's the case with any type of debt. If a company decides that they want to do a bond issuance or a bond issue or selling bonds, I'm saying all of this because it's all the same meaning. They have to decide how many bonds they want to issue, what the face value of each bond will be, and what the interest rate is going to be, right? And sometimes we refer to the interest rate as the coupon, because back in the day when bonds were really still paper, there would be little coupons attached to the bottom of the bond, and the bondholder would tear off the coupon and mail it to the company, and the company would mail back the check for the interest. This was really back in the day before all the technology kind of rendered these types of things moot. So, when we talk about the number of bonds to issue, in this case where we were over here, it's kind of just showing 5,000, right? But it doesn't mean that it's only one bond that was issued. They could have issued 10 bonds and each bond has a $5,000 face value, which means they raised $50,000, right? Or 100 bonds or whatever. And all 10 or 100 don't have to go to the same investor. It could go to 10 different investors or 100 different investors. So please just bear that in mind, that sometimes it's, especially in these questions that you get asked, sometimes it's, you get one amount and it says the company raised, $50,000 and you do the journal entries, or it could say the company issued 10 bonds of 5,000 each, and then you have to do the calculation to get to 50,000. The face value, which we kind of just discussed, is the amount the company will pay the investor at the maturity date. That's the $5,000 we spoke about. Contractual rate, the interest that the company will pay. It's usually stated as an annual rate. Okay, so the 5.75 over here, it doesn't even say annual, but it's accepted, right, in practice that that's an annual rate. And then the bond, the contract will say whether it's paid semi-annually. In a lot of our examples, it says that the interest is paid semi-annually. So that means the 5.75 has to be divided by 2 or 6/12 or whatever if you are being asked to make journal entries every 6 months, right? You got to put the portion that belongs to that part of the year into each journal entry. You can't take the entire annual interest every 6 months. It has to only be half. And like I said, you could trade bonds on securities exchanges. We saw the example of Twitter. So, just one example here, how do we do the journal entry for issuing bonds at face value? Face value is the same as par, P-A-R, right? All this terminology can get a little bit wild. So I want to make sure that that you have at face or par value. In this case, is $5,000. So you're issuing the bond for exactly the amount of money that that you are supposed to be paying back at the end. So let's just read this scenario. We will do examples, but not today. I'm just talking with you today. On January the 1st, 2013, Candlestick Corporation issues $100,000. So see, that's just the total dollar amount. You don't know if that's 10 bonds of $10,000 or, it doesn't matter. This is the dollar amount that needs to go into your journal entry. So this is the face value. They issue or sell $100,000. So they're raising this money. They're borrowing from people. So 100,000 is what they receive. 5-year, that's the term, TERM, term of the bond. That means that in 5 years' time, they have to pay back the 100,000. 10%, that's the contractual interest rate expressed annually, right? So that's what for every year, what people are earning on this amount. At 100, so this gets very confusing. It's like they're issuing $100,000 5-year. It's that's the face value is 100,000. 5 years is the term. 10% is the contractual interest rate. At 100 just means that it's not being issued at a discount or premium. It's not being issued for more or less than 100,000. It's just being issued at face or par value. The reason they have to say this is later on in the chapter, you'll see that companies can issue bonds at more or less than face value. So the bonds pay interest semi-annually. So remember, I told you the question will often say what the interest payment period is. And in this case, semi-annually on the 1st of January and the 1st of July. Now, you want to be careful when you think about interest. Interest is going to accrue over time. So on the first day when the bond is issued, there's no interest at that point, right? There can't be interest immediately because interest is representative of like the amount that we're paying for, I guess, the ability to use someone else's money. And on January the 1st, 2013, we haven't yet done that. So the first interest payment would be on July the 1st, when the first 6 months have passed. Okay, so the journal entry to issue the bonds at face value, the company is borrowing money, issuing the bonds, they receive the cash, so cash goes up on the debit side, the asset cash increases on the debit side, and they recognize a liability, long-term liability called bonds payable of 100,000. That's the journal entry for issuing a bond at face value. You debit, it's always the same, okay? You debit cash, you credit bonds payable, and you take the face value of the bond as the amount that you include in the journal entry. And bonds payable is a long-term liability in the balance sheet. Why? Because it's 5 years that they're going to wait until you pay them back. And what makes something long-term is if it's going to be paid back in more than 1 year from the balance sheet date. So this is also the title of the chapter, long-term liabilities. All right, so that's the issuance of the bond. I'm just going to talk about the interest, and then guess what? You can leave early today. Ooh, exciting, right? A whole 20 minutes. So 100,000, that's the face value. I think, like I said, it's always the same journal entry, right? So I think this should be able to stick as we do some more examples. And then the bond interest, how do you calculate interest? In this case, you have to look at the amount, the dollar amount of the bond, which is the face value. You have to multiply that by interest rate, which is 10%. And then you have to think of how much time has passed in terms of 1 year. So like I said, on January the 1st, 2013, there's no interest yet because no time has passed that would make the company have to pay for the privilege of using the money. But by July the 1st, the first 6 months have passed. So now 6 months of interest has to be paid out. So we say 100,000 times the 10% interest rate, either divided by 2 or multiplied by 6/12. However it's going to come out to the same thing. But because interest is semi-annual, you're always only going to do 6 months at a time, and that comes to 5,000. Interest is an expense, so you debit the expense because you're showing that your expenses have increased, right? Interest is the cost of borrowing, so it's an expense. Debit that for 5,000, and we're paying it out immediately, so we credit cash. Cash goes down by 5,000. If we were not paying it on this day, and we were just accruing it, the credit would go to interest payable. All right, so that's issuing bonds at face value plus interest. I'll go over and this is what I mean about interest payable. I'll go over the rest of this next time. I think we've done enough for today. I'm sure you agree. You were probably done 10 minutes ago. And yes, I'm still gonna stick around until whenever people need me. So let me just do a few things. But we'll continue, we'll stop here and I'll continue from here next time. And like I said, I'm trying to organize the situation to see when I can do a review with you guys for the test. So let me stop the recording.